What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is March 6th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's Macro Monday, we're going to be spending some time to dive in not only to our estimations for where Bitcoin could be heading after the recent pullback in price down to where we were back in mid-February, but on top of that, I want to spend some time to dive into the macro charts, because while in the short term, we think that there could be a bit of continuation to this optimism in the market, continuing to get people to believe that we are at the start of a new bull market across all asset markets, we believe that this is yet again going to be a broader liquidity trap. So we'll go throughout the video. It'll make much more sense as we dive into some of our different charts. If you guys enjoyed this video, consider dropping a like and stay tuned later on as we've got a really exciting sponsored review for Aavegotchi, which is a really exciting NFT project in the ecosystem. But more specifically, we're going to be talking about some major changes to its governance token. So stay tuned to it. You guys won't want to miss it. All right, so let's go ahead and dive in here towards the technical analysis and price action here for Bitcoin. As we again have talked about for the past week, we are in what many people see as an accumulation channel that could be the beginning of the bottoming formation for Bitcoin. And while we're not entirely sold on this, as we have remained in this range since back during May of last year, I think that it's definitely getting to a point where, at a minimum, this could be the bottoming range for Bitcoin, and that we could start to see a slow deviation away from the broader asset markets. However, at the same time, that does not mean we aren't coming down here to where we were back in November, and that we couldn't move lower in the broader term of things. And I think that's the direction we're heading in the grand scheme of things. The reason being is because we are already starting to get, as we take a look across the chart, resistance at the typical range. We faced resistance back in August, not to mention in a period of time where the Fed funds rate is at an even higher rate than before, and bond markets are predicting that rates are going to get even more tightened than they are right now, rising to higher levels and therefore increasing the cost of capital. That is going to squeeze and contract assets like Bitcoin. It's going to keep them suspended lower, because that's going to mean that a lot of the easy, cheap money that came from quantitative easing and quantitative tightening is going to remain out of the picture. It's no longer going to be able to provide support. And even here on Lux Algo, while again, the green band has been providing some support here and has given a few strong signals here within price, the major overwhelming trend and the majority are sell signals here on these big red candles. This is a sign, a typical visual sign through both volume profile, but also through price action of distribution. I gotta tell you guys, this does not look like a substantial or sustainable kind of rally. This kind of breakout here where we're just chopping off to the side, facing resistance at continuous levels that we've seen in the past, that's not what we want to see. And it's not exactly how we played out back in 2019 during that period of time after the bottom of the 2018 bear market. It's a lot different comparative in regards to price. So a lot more optimism and continued follow through. And even with that, we need to understand that that rally that went all the way to 14K from 3,800, well, that rally faded back down right down to the lows just a couple months later. So again, we want to see a more substantial bottom formation, and perhaps this is it, but it means that we're likely going to get another retest down in this lower range. So if you guys are convinced that that is the bottom range, I would at a minimum dollar cost average more heavily or make more entries more aggressively at that lower range. You're going to be able to scoop up a lot more Bitcoin. Not to mention, in the short term, I think that there's a chance that Bitcoin could maybe chop up, have a third shoulder or a second shoulder here in the head and shoulders pattern for Bitcoin. Perhaps that's what we get at the end of the day. But all in all, if this isn't the next bull market, I'm not interested. And if we can't get above this supposed accumulation range and make it support and sustain getting above the 200-week moving average for a long period of time, I'm not really interested. I don't like getting these sell signals around this range and not being able to get above what used to be the buy the dip indicator over the last decade. If that isn't happening, well, I don't want to be touching Bitcoin with a 10-foot pole, so to speak. So again, we're going to continue to remain patient here. We're not feeling the FOMO right now. Prices are where they were back in late January. Price has really not moved substantially since then, since that short-term rally. And if you missed that rally, that might suck at the end of the day. Like, you can always beat yourself up for it. But to be honest, since then, price has just been chopping. And it's probably left a lot of people getting out of their positions, right, who were shorting down here, right, knocking those people out, whether through forced liquidations or through people just simply taking their losses. And you got a lot of people counter trading, starting to go long here into this optimism, thinking that they need to catch price before it gets above the 200 week because it's just going to absolutely go supersonic for some reason. That's unfortunately how so many people get trapped into this distribution phase. And if you guys need any further proof, yet again, week by week, we are seeing negative market order flow through our partner Bookmap. Now, as you guys know, Bookmap has multi-book. This is a way where we can see the market order flow across a whole range of major exchanges. And you can do this on spot markets and futures, but we mainly like to look at the spot market. That's the real deal. And it shows us what the whales are doing in the market when it comes to the actual buying and selling pressure. And we want to chase the direction of the market order flow because it showcases where the demand is. And the demand right now, especially back here on March 3rd, set the tone. We are clearly seeing outward market order flow, people taking advantage, unloading large sums of Bitcoin during these heightened periods, waiting for dip buyers to drive it back up, dumping yet again. Not doing it all directly in one swoop, but doing it over a suspended period of time, taking advantage of that optimism to absorb that liquidity. And only then, when they finally offloaded their positions, finally will you start to see price going in the other direction. When the weight gets too heavy, when there's no longer that period of time where they can simply engage in distribution on their positions and price finally starts to get weighed down. I think we're getting there. I think we've got maybe one more wave here to get people optimistic, a potential deviation above that 200-day where we fall back down below would be the perfect price point, in my opinion, to potentially get a short position and cause max pain, not only to shorts in the market, but also to the longs. That's the name of the game. We got to think about how the market makers and large participants would want to cause the max pain to traders and the retail crowd and the broader trading crowd, okay? Now, another thing I want to talk about is Total 2. I know a lot of people have been asking me about altcoins, what's my sentiment on altcoins at the moment, and the big thing that I keep coming back to is that altcoins are not only more risk on than Bitcoin, and we don't really remain quite optimistic on Bitcoin at the current moment, but on top of that, to make matters worse, if we take a look against the broader bear market, a lot of people think, since back in June, we've been in the beginning of an accumulation channel. And I can understand where that thought comes from. Price has been, or valuations have been roughly between $430 billion to $700 billion during that period of time. However, there's a big problem, in my opinion, with this way of thinking. If we take a look at the Lux Algo tool, which you guys can get access to at the link down below in the description, there's a 30% discount off right now, and you can use it across any chart on TradingView. The really interesting thing is that last time around, we were getting a mixture here of buy signals, right, when we would come towards these dip ranges. And again, we are not seeing any type of optimism coming in just yet. Price and the trend has been relatively neutral after the take profit mark here on the pullback here when we got the sell side signal back all the way in January of 2022. While the indicators are absolutely not 100% perfect, no indicator is, what I really like about the overall indicator suite from Lux Algo, especially the key one here that signals momentum shifts and potential trade setups, is that it's very good at capturing the broader trends, right? And during these periods of long interruption, right, where there's a lack of interruption in the trend, this is where you really make your money, on the upswings and on the downswings. It's not about picking bottoms, not trying to catch a falling knife. It's about knowing when you've got the clear signal on that weekly time frame that it's time to go long. And again, even during the last bottoming phase, we had these mixtures of buy signals, some short-term strong sell and strong signals. So far, we're not seeing any of that right now. And if I'm just looking at price itself, guys, it doesn't look optimistic whatsoever. While some people may draw comparisons and the similarities of price structure, it at a minimum means one of two things. Either it's going back down to the lows around $400 billion, like we saw in the previous bear market, or even worse, it could be pointing towards going towards even lower levels. And I gotta tell you guys, if you're looking for the cream of the crop when it comes to risk on, look no further than altcoins. And as we enter into an extremely risk-off environment where the world is preparing for a recession, where the Federal Reserve and other central banks are continuing to tighten their federal funds rate and their balance sheets, as we're having monetary contraction, how are altcoins going to do good in this environment? I just simply don't know how that's going to work. I know some people believe that crypto lives in its own world, but again, that's a bet. If you're willing to afford to make it, that's fine. But my goal is to preserve capital right now, not just for myself, but for you guys as well. I want you guys to preserve your capital so that when we get that real capitulation event and when we get a real trend reversal, that's when we can strike. That's when we know the trend is clear and we just ride the wave. It makes it so much more simple, and we don't have to risk a large amount of capital because we know that the trend and the institutions, the accumulators, are on our side, and that the Fed eventually will be on our side when the time comes. Again, I want to point here to the Ethereum chart. The continued weakness here over the past few weeks has been gravely concerning, especially seeing this continued stagnation in crypto and equity, crypto, whether it be in Bitcoin or altcoins, especially when we've been seeing a bit of a recovery in equities over the past 3 days. Now, again, the Dow Jones here, which we're taking a look at just to kind of showcase the base price, is already itself concerning. We've continued to face resistance at a continuous range that was previous support back in December 2021 and January of 2022, but has since been resistance time and time again since the period of time throughout April. This is not looking good. And again, I really want to emphasize that if we can't get above this range, right, even if we deviate it, right, and we flash back down, right, if we can't hold above that range and make a new support or start establishing higher lows and higher highs above that range in the Dow Jones, you can say goodbye to any potential chance of a new bull market forming. If the Dow Jones itself, which structurally is made up of the 30 largest equities like Apple and Microsoft and consumer cyclicals like Procter & Gamble and Johnson & Johnson, if these stocks are not making higher lows and higher highs, there is likely no chance that the NASDAQ or the S&P 500 are going to do the opposite, that they are going to charge forward. While these have been market leaders in the past, not only is it very unlikely for market leaders from the prior bull market to continue being market leaders again, but on top of that, it is going to need the weight of these stocks to at least be moving up. The stock indices do move in general alignment, either to the upside or the downside. And again, I want to bring you guys to one chart that I think is going to set the tone here, that really closes off our conversation, and that's the long-term VIX chart. I keep coming back to this. I know it may be a bit repetitive, but if you guys need a chart that is telling you something has been building up for a long period of time, over 5 years, the market has slowly but steadily started to price something in. Look no further than the VIX. The VIX is the volatility index for the options contracts on the S&P 500. And ever since back here, 2017, right? Really January 2018, it's been about pretty much at this point 5 and almost a half years where the VIX has been setting in higher lows in a continuous upward line or band of support. What does that tell us? It tells us that the market is growingly uncertain, that at its base foundation, as time progresses, year by year by year, the market knows something is up, that we are due for a real recessionary bear market where the Fed does not step in like it did back in March of 2020. Something very bad is eventually going to happen here. And we don't know what's going to break, what the catalyst will be. Similar to back in 2006 and 2007, before 2008, many people didn't know what that was going to be. Some people pointed towards the housing market. Other people just simply didn't expect it. The key thing here is this: the volatility of structure is signaling something is up. And if you guys want to go long equities when we're going right into the pocket that each and every time paved the way forward to go short, be my guest. Right? I'm not here to try to tell you guys I've got all the answers, and I'm not trying to prevent you guys from doing what you want to do. Again, everyone needs to think for themselves. I think everyone should do their own due diligence, but I'm just here trying to tell you guys what I think is genuinely the case. We are in cash at the moment for the vast majority of our positions. We've got some small trades going on at the moment. We got a little bit of crypto positions that we're holding on to, but we're overwhelmingly in cash. And we've been that way since back in August. It's not about catching every single move or even fretting if Bitcoin gets above where you cashed out of your position, right? It's about knowing whether or not the trend is there. We've rode the trend each and every time. We rode it back in 2017. We rode it back in 2018 and 2019. And we are going to make sure we ride the trend this time around. But we haven't seen the signs of real capitulation, in my opinion. Not yet. Not in the form of a recessionary bear market like we're going through now. So, again, guys, it's important to make sure that you got the tools to combat this challenging environment. Not only the charts to watch, but on top of that, tools like Bookmap and tools like Lux Algo that are going to help you to get that edge in the market, where you guys can find the links down below in the description. It's a 30% discount off right now on Lux Algo, and you guys can get 20% off on your first month of Bookmap using the code down below in the description. But outside of that as well, guys, let's go ahead and dive into one of the few exciting projects within the overall crypto space when it comes to NFTs in the Polygon ecosystem and the major governance proposal that they're going through. And that is no other than Aavegotchi. Alrighty, everyone. So in today's sponsor review, I want to spend some time to talk about one of the more exciting NFT projects in the crypto space, but more particularly talk about some of the major updates they have coming to their governance token, which could provide us a really interesting opportunity to keep an eye on in the crypto space. Today, we're going to be talking about no other than Aavegotchi. Now, for those of you who are hearing about Aavegotchi for the first time, I do want to give you guys the quick 60-second primer about what the project is all about and why it's an interesting NFT project versus the crowd. But more specifically, I want to spend some time to talk about this opportunity around the Ghost token, which is Aavegotchi's native governance protocol token, and why the changes that it has coming up in the near term may be a really exciting change for the overall ecosystem and allow for a lot of investment to flow back into the Aavegotchi ecosystem, which is already growing at a pretty rapid pace. So without further ado, let's go ahead and kick off with the basics. So for those of you who are hearing about Aavegotchi for the first time, Aavegotchi was founded back in 2020. It's one of the early stage ecosystem plays in the NFT space, but more specifically, it was founded as one of the first major NFT projects on the Polygon network, even as far back as when it was known as Matic. And some of you may remember those days. It's been some time. But Aavegotchi is one of the few exciting NFT projects for me personally. As you guys know, we usually don't talk about NFTs here on the channel, but Aavegotchi is a bit different because whereas most NFT projects fall flat by just being some digital collectible or more specifically a profile picture that you put on Twitter, Aavegotchi can be all those things for sure, but it's much more than that. Aavegotchi is based around the famous and well-known 1990s toys Tamagotchi that came from Japan. Many of you, probably like myself, either yourself or through friends, had Tamagotchi collectibles. They're these virtual pets that you had to take care of, pay attention to, and you can improve over time or add certain collectibles or items to. It was a really fun and addictive game, and Aavegotchi has played off of this utilizing the Aave branding, allowing you to have a digital collectible NFT that you can dress, that you can play with, and on top of that, add skills to over time, and have different degrees of rarability in the sense of its value. However, putting all that aside, while I do want to talk about that later on, and while I think it's a very unique thing about Aavegotchi, there's also something much bigger at play here, and that is the removal of Ghost, the native governance token's bonding curve. Now, this is going to take some time to explain here, but I want to go ahead and preface it by saying that this has to be one of the more exciting governance proposals in the entire crypto space. So much governance talk is noise, and there really isn't much major changes going on. But in the case of Aavegotchi, this is probably the biggest ecosystem change that it has seen, and it's going to be one of the biggest ones we've seen in practically any NFT project when it comes to its protocol token. So before we understand what removal of the bonding curve is, we need to understand what a bonding curve is, but more specifically, we need to understand how Aavegotchi initially raised capital and launched its governance token, Ghost. So first off, let's go ahead and step back and talk about what a bonding curve is. Because with this proposal that's coming through here, we've seen a major change in the overall token price since this news has come out. And it seems like there's only upward momentum, at least so far. So in order to understand what a bonding curve is, we need to understand how the project raised its capital. The vast majority of crypto projects will usually do an ICO or some type of private raise. This is where strategic investors or venture capitalists essentially get in at some fixed discount price before the token gets listed on a variety of exchanges, where thereby retail investors finally have an opportunity to buy in at a much higher price. Not a very favorable system. I'm not a big fan of these traditional raises, and on top of that, as investors, most retail traders aren't either, as people have started to realize how unfair it is. Well, Aavegotchi has not only been focused on decentralization from a security perspective, being one of the most decentralized NFT projects out there, but on top of that as well, they've been focused on opening access to everyone and allowing everyone to have an equitable entry point into the project. And that's what they did. Back in 2020, Dan and Jesse, the co-founders of the project, found a really interesting piece of code that was open sourced by Aavegotchi, one of the leading Ethereum projects back during the day of the early stages of Ethereum. And they created a really interesting bonding curve model that allowed you to essentially launch a token onto the open market with a balanced amount of liquidity at a set price. And it would allow people, anyone on chain, to be able to go out and purchase that token at a set price. Essentially speaking, as time progressed and more tokens were bought, the price per new token minted or purchased from the bonding curve would go up. And vice versa, if people wanted to sell their ghost tokens into the bonding curve, it would lower the price over time and reduce the supply. This is a really interesting mechanism that allows for an expanding supply with expanding buyers and users, but also still benefits price to the upside, and vice versa. If people are moving away from the ecosystem, they want to sell, they can sell out into a liquid stablecoin. In this case, DAI, a decentralized stablecoin that's been around the space as far back as DeFi was a term. Now, we've been big fans of DAI here on the channel, and it makes total sense why Aavegotchi at the time had utilized DAI as its stablecoin, as it's highly liquid and also is highly resilient due to the fact that DAI was basically over-collateralized by a singular asset, Ethereum. Right? So essentially, in order for new DAI to be minted, there needs to be basically, if you were to create, let's say, $100 worth of DAI, which gets generated from collateralized debt positions, it's really complex. But at the end of the day, essentially, if you have $200 of Ethereum, you could mint $100 worth of DAI. And ideally, you would have likely even more ETH or collateral behind it. So that's how DAI got generated back in the day. However, the project has had some serious changes over the past couple of years, and it started to really put DAI's resilience into question. Jesse, one of the co-founders of the project, put out this proposal in January because he and many others have started to notice that there could be some grave security concerns for projects that are relying on DAI as their native stablecoin, and that it may not be the resilient stablecoin it used to be. Now, why is this? Well, first off, DAI eventually, through the MakerDAO, this is the overall governance protocol that allows you to generate DAI. Essentially, they started to allow utilizing other types of assets. And rather than just using crypto assets in order to mitigate volatility, they thought it would be good to start allowing you to use altcoins and even centralized stablecoins backed by dollars, ideally in some bank account like USDC or GUSD, now minted from the defunct Gemini, which used to be one of the leading exchanges, but is now in a state of bankruptcy with a major hole in its balance sheet. Now we've got to ask whether or not that GUSD is really valuable anymore, and in fact, whether or not it's vulnerable to losing its value, and therefore weakening the collateral behind so much of the DAI in the ecosystem, enough to where it may even break the peg in the future. Now, this is something that is quite concerning because the governance system has tried to remove these types of assets, but unfortunately has failed to do so. The vast majority of the governance is still voting on keeping these types of assets, which makes all the DAI in the ecosystem potentially at risk, and potentially a risk of depegging and losing trust in the one-for-one dollar value for each DAI token. Now, this is already one concern as it is, but as I mentioned earlier, MakerDAO has continuously expanded the pool of available assets you can use as collateral, and they've even allowed people to start using the governance token of MakerDAO as collateral. I gotta tell you guys, as someone who's been a supporter of the DAI stablecoin and the MakerDAO protocol as far back as 2019 when I got passionate about DeFi, this is just utter madness. And it's not only madness from my perspective, but from so many people, even Jesse and Dan in the community. There is a lot to be concerned about here. And that's why Jesse put out this proposal in January. Now, after community discussion and people providing feedback and discussing it, they came up with a proposal to essentially disband or stop operation or cease operation of the bonding curve, and instead to take the DAI from that pool and redistribute it across 4 different avenues to focus on liquidity, providing some capital for the core team that's adding value and building applications around the Aavegotchi ecosystem, for liquidity and community rewards. This 25 4-way split seems to be one of the most fair proposals, and it's probably the reason why the quorum voted for it within the Aavegotchi ecosystem. With this change now, it's going to allow for all of this DAI that was originally sitting in that overall bonding curve to now be utilized. Originally, the bonding curve served a great purpose in the early days, but nowadays what it serves as is practically a low slippage, easy exit opportunity for those who have large stakeholdings of Ghost token. That isn't very favorable. And on top of that, having exit liquidity like that doesn't incentivize people to really be long-term stakeholders and utilize that capital for positive purposes. So this is why disbanding the bonding curve brings about 2 major benefits. It allows that DAI to be distributed to active contributors, people who are working within the ecosystem. But on top of that as well, it's going to have a major side effect that's positive likely for price in the long term, and that is it's going to cap the supply. Now again, going back here to the topic of the bonding curve, with the closure of the bonding curve, whenever this curve is finally closed, this is again capping the creation of new tokens. Right? Again, the bonding curve had this mechanism where if people wanted to purchase with the DAI stablecoin new Ghost tokens, they could do so and create an infinite number of tokens essentially. There was no hard cap. But now with the bonding curve being closed, this essentially sets a hard cap for the supply of Ghost tokens or Aavegotchi tokens. Hence why we've seen a major price move here. Now, whether or not this is going to continue, that's something you got to determine for yourself. I'm not here to tell you guys that you have to go out and rush and buy it, or that you even have to buy Aavegotchi NFTs. It's something for you guys to determine on your own. But I have to say, this is definitely interesting to see, and the amount of buy pressure that came in here during this period of time in February, following the proposal and the passage of this and the continued community discussion is definitely a positive step in the right direction. Another thing as well that's gotten a lot of people in the ecosystem really excited is the launch of Gotchi Chain. Now, as I mentioned earlier, Aavegotchi has been around as far back as 2020, and Jesse and Dan were early stage adopters of the Polygon ecosystem, even back when it was known as Matic. That's why they're one of the first projects to be working with Polygon supernets. These essentially serve as side chains for the overall Polygon ecosystem. And in the case of Gotchi Chain serves as this hyper-frequency, high transaction throughput network where there's some types of different applications and games that won't be dealing with the core Aavegotchi assets themselves, but allow for Aavegotchi's ecosystem to service some really exciting decentralized applications and still have some degree of decentralization for those different types of transactions. So this is really exciting stuff, and it speaks to the continued expansion of ways where you can interact with the core Aavegotchi NFTs and the broader ecosystem of holders. So this is again really exciting if you're interested in the Polygon ecosystem. It's one of the biggest projects where you can kind of garner that exposure to Polygon as a whole in regards to its NFTs. So if you're interested in the, say, Bored Ape Yacht Club or CryptoPunks of the Ethereum ecosystem, Aavegotchi is akin to that in regards to the Polygon ecosystem. But putting all that aside, whether or not you guys find this news really bullish when it comes to the token supply and removing the bonding curve, whether or not you think this is a good thing or not, I think at the end of the day, Aavegotchi definitely deserves some major kudos. It was found in a decentralized way and proved even as far back as 2020 that there are better models out there than the traditional ICOs that tend to be very centralized and thereby rely on centralized exchanges. But Aavegotchi itself focused in on having an organic community, having people who love the idea and want to contribute to it. And it's not just some team that's building things. There's contributors from the community that are not only contributing ideas and participating in governance, but adding value in ways to interact and build on top of the Aavegotchi ecosystem. I think it definitely deserves some major kudos for that. They've got over 100,000 wallet holders for the Ghost token, thousands upon thousands of different Aavegotchi holders and participants. And on top of that as well, there's deep liquidity across a major amount of exchanges from Binance to Coinbase, which tells me that Aavegotchi itself is one of the few projects that actually stands on its own 2 feet and really has potential to continue growing long term. So if you guys are interested to learn more about Aavegotchi, I recommend you guys check out the links down below in the description. I'm going to put the Discord there and the Twitter there, where you guys can not only keep up to date with some major changes within the Aavegotchi ecosystem like this, so you guys don't miss a beat, but on top of that, where you guys can talk to other community members, you can ask questions, do your own due diligence. I'm not here again to give any financial advice. I want you guys to go out there and see if it's a project for you, if you resonate with the community, if you resonate with the concept of Aavegotchi and how you interact with them. But above all, guys, I hope you do your own due diligence. Take a look into it if you have the time. And if you enjoyed this review, consider dropping a like and consider subscribing if you haven't already. And until the next video, everyone, thank you all so much for watching and giving me some time to ramble. And until the next one, I'll see you all in the next video. Take care, everyone.